Today I'm going to go over a lesson that took me a long time to learn when I was a novice trader. Many people make this mistake, and it's a very simple rule. During the advancing phase of an intermediate cycle, the correct strategy is to buy dips, not sell short, trying to catch a counter trend move. The opposite is true on the other side of an intermediate cycle. So in the declining phase of an intermediate cycle, the correct strategy is to sell rallies. So you're going to see, and many people try to go against this rule. We've seen it multiple times in the stock market. I've warned people over and over not to short the stock market. It's in a very strong upward trending move. Nine times out of 10, you're just going to lose money. And here is the insidious part of this strategy. It's like gambling. When you go in the casino for the first time, if you win, you become addicted. You think it's easy money, and so they hook you. And then you go back, and of course everyone knows what happens if you keep betting, is eventually you lose all your money. It's the same thing with counter trend trades. If you make money at it, if you win once or twice, then you become convinced that you're smart enough to beat the market, and then you start to make these trades often. And then by the time your trading career is over, you've probably given away thousands and thousands of dollars that you really didn't need to. If you'd have just taken this rule to heart and you don't sell short during the advancing phase of an intermediate cycle. You don't buy long during the declining phase of an intermediate cycle. So here's the problem. In the advancing phase of an intermediate cycle, the dominant trend is against you if you're going to sell short. So you have no margin of error. If you're too early, so like I'm just going to use the gold chart here as an example. So let's say somewhere in here you tried to pick a top to the cycle and you went short, and then the market surprised to the upside, and you kept holding, expecting that correction into the daily cycle low, but then when it came, it wasn't deep enough to rescue your position, and so you lost money. Same thing here on the downside. It's only the inverse. This has been an exceptionally long daily cycle. You could have started trying to pick up a bottom in the daily cycle decline anywhere in here, and look what has happened. If you were early and the market has been surprising to the downside, now it's gone so far underwater that you have basically no chance of rescuing your position when the bounce comes, because it's going to be a left translated cycle. It'll top quickly and then roll over and make another leg down. So you have no margin of error on these counter trend trades against the predominant intermediate trend. So I'm going to widen the chart out just a little bit here. I saw several, if not many, traders blew up their portfolio during the baby bull rally because they were expecting a daily cycle low during the normal timing band for that event to happen, but instead it took 4 months for gold to produce a daily cycle low. In the meantime, the traders that were heavily into dust, they just blew up their account. A classic example of what can happen to you during trying to trade against the predominant trend. And then when we did finally get an intermediate decline, it was so shallow, and then we got another leg to the upside. So again, anyone trying to play that downside probably just didn't produce enough of a downside move to rescue anyone's position. So we're in this same scenario right now. Gold is in the declining phase of its intermediate cycle. The surprises keep coming to the downside, and I keep seeing people trying to pick that bottom, and they're trying to catch the move out of the daily cycle low. But even when it comes, it's not likely to last more than, they can top as fast as 2 or 3 days, and maybe if you're lucky it goes 8 days. So you've got a very short window to make money here, and if you don't time the bottom of this cycle low correctly, then it's just not going to bounce enough to rescue your position. So it's just not worth trying to trade against this, the predominant trend, which is the predominant intermediate trend is down. It's not worth trying to trade against that. And probably the worst thing that can happen to someone is that they get lucky and they catch one of these and they make some money, and so then they think that they are smarter than the market, and so now they've locked themselves into thinking that they can take these trades and make money. And I guarantee you, if you continue to do this over the life of your trading career, you will end your trading career with a lot less money than you would have had if you had just learned this lesson, learned it early in your trading career, and then obeyed it for the rest of your career as a trader. The same thing is going to apply to the stock market. As I've said over and over for months and months, actually for over a year, it's just not worth trying to short the stock market. Not only is the plunge protection team protecting the stock market, but it's in a very strong bull trend. I'm pretty sure we're starting the vertical phase of the bubble phase right here. And yet I continue to see people try and pick a top over and over and over, and the predominant trend is against them. The surprises keep coming to the upside, so of course what happens is they just keep losing money over and over and over. And I've said this before, the quickest, most efficient way ever devised to lose money is to try and short a bubble, the final bubble phase in a bull market. That's when markets can just go vertical, and people that are trying to pick a top, they just run the risk of blowing up their account, just like the traders that tried to pick a cycle top during the baby bull market. So the quicker you can learn this rule and the quicker you can make yourself obey it, the much better chance you're going to have of making money, and I guarantee you're going to have a lot more money in your account when you finish your trading career 2 years from now, 10 years from now, 20 years from now, if you'll just do not sell short during the advancing phase of an intermediate cycle. Do not buy long during the declining phase of an intermediate cycle.